Gurmeet, hi. Thank you so much for speaking with us. Just wanted to begin by asking you your market, setup at this point of time. Do you believe those high levels are likely to come, those record high levels soon, and post that the rally will continue, or we'll hit the pause button there?
Thanks, Anisha. I think markets eventually will make a high. I think the million-dollar question is when. I think, but clearly the positioning has changed. Even if you look at while the FIs are still net short, but if you see, for example, in May they pumped in almost 44,000 crores. The June inflows have been pretty favorable so far. The retail book, anyways, continues to do well with SIP book now almost 14,000 crores plus consistently. So I think the positioning has changed, and I think now it's more like what probably was seeing for last 18 months was sell on high. I think the positioning is clearly now on buy on dips, and after a long time, if you see the price action in especially in mid and small caps, it's suggesting that the sentiment has really changed. So it's important that we don't get carried away because that's when you make mistakes. Just be focused on buying at the right valuations. I think it's extremely important because interest rates will remain high for some more time before you see the cycle reversing. So it's important to give a fair value. And I think the pocket of the market which was very not doing well, underperforming, just for example, the insurance stocks. We saw maybe some bottoms up even in pharma happening after pharma having a very bad quarter. So I think there's a bit of rotation now happening towards things which are probably more reasonable.
Right. Okay, just looking at some of the other buzzers. Right now, Tata Motors, of course, that's scaled up a good 3% as we speak right now. That's sitting at a 3-year high, clearly. Gurmeet, conviction that Tata Motors is going to now scale up even further from here, and the story may have just begun?
A couple of things. Tata Motors has a lot of moving parts. I think the guidance of being net cash flow positive in FY24, I think really helped. They are deleveraged to a large extent, and I'm very positively surprised by the JLR wholesales. So if you see the bookings and the order book for Defender and the Range Rover, I think it continues to look good. Indian passenger cars continues to do well. I think even the CV is now coming back. We even saw, I was interacting with the Eicher team some time back, and I think they are also guiding now for a double-digit growth. So I think it's all about all things coming together. Plus China, I think, is a big factor. We've seen some rate cuts and some monetary easing there as well. But I think, again, as I said, it's run up quite quickly. So maybe could be in for some consolidation. But overall, I think the outlook remains constructive for auto. Also, I think now the rural-facing stocks, which is the two-wheelers, the tractor makers, and the entire auto ancillary value chain, will also start looking up as we see increase in MSPs, more cash in terms of various states. Now we have 4 states elections also this year. You will see more on fertilizers also. So I think even the rural facing side of auto will start looking better now in the second half.
We wanted to understand where you think the upside potential, if at all, is within the insurance pack. And are you looking at this space to invest?
So, we've been very long-term investors in both HDFC Life and Lombard actually since IPO. Lombard maybe pre-IPO. HDFC Life, what's probably happened is that after the unfavorable announcement in the budget, industry started and analysts started working with a degrowth of 10 to 15% in APE. And what has happened in April and May, actually, if you see the numbers which come, they've actually grown 8-9%, and then Vibha guided for a mid-teen growth in APE. In fact, if you see the VNB margins also, they've maintained the margins at 28 to 30%. Which means that the product mix is changing as the regulation goes. And I think the regulation was above 5 lakh and above premium. So I think we probably, the sense I'm getting is probably there was some bit of overreaction as far as that segment is concerned. Also, I think the Exide Insurance merger is now creeping in, the synergies. They are making a mark in tier 2, tier 3 towns. I think HDFC and the merger also would present more opportunities. So the guidance look good, but yeah, the valuations are slightly now back to above me, they become reasonable. I think so. We continue to like that. We also like Lombard. I think as the motor insurance portfolio improves, the other portfolios are anyways doing well. I think the total ratio will continue to improve. Uh, LIC also, in my view, at 0.6, 0.7 embedded value. I think that's another one which hasn't done as well it should have for both business and non-business reasons. I think that's another one which I think we are tempted to look at. We haven't really started adding.
So that's about the insurance space, but do remember that's a long-term bet coming in, so don't expect a sharp reversal anytime soon. Having said that, Gurmeet, a sharp reversal is what we have seen in a lot of these new age tech companies. If you look at the last 3 months, we have seen quite a bit of rally in the names like Zomato, even Paytm for that matter. And since the analyst meet, there's this renewed interest in Nykaa as well. Your take on some of these names?
No, we staying away as far as so it's not that we completely dislike the new age companies, but it's just that the environment is that right now they're not in the green. Moment they become in the green, the P's will look pretty different. At some point of time, probably with Zomato at maybe $50 or even the Paytm at all time low did have some kind of a value tactical play. But I would like to wait for a few quarters. I want to see if this trend actually translates to earnings becoming positive without adjusting any ESOPs, etc. My for 15-20 crore profit, I don't think so. Paying a 35-40,000 crore market cap would makes sense. I think what we are more likely to now look at more some fintechs and companies which are having this phygital model and doing credit creation. So the likes of Equitas, the likes of Credit Access Grameen, maybe Poonawalla to a certain extent. I think because what we are seeing now is formal credit reaching to those sections where it wasn't available. They were dependent on informal lenders. And I personally think after a long time, I have not seen corporate balance sheet this leverage and in this good shape. So this thought of that, the credit cycle has also peaked out and everything will compress. I think this is little overdone. I still think the bank credit will continue to do well, led by pockets with access to formal credit.
Gurmeet, is there any fresh space or fresh ideas that you have looked at in the last 2 to 3 months? Any fresh buys from you?
So we are actually looking at some niche plays, in exports. So we like textiles. We added Gokul as exports. So we didn't realize it will go up so sharply in last month. The reason was that once we did our research, we figured out the spring orders had started coming in much earlier, and also the number of inquiries, despite the UK treaty not happening, have picked up. Also, the new plant in MP actually is added to more efficiency. So we added some niche players there. We are looking at QSR as a theme. I think that entire space is just 70,000 crore market cap. I made this mention earlier. I think the way our eating habits are changing, I think the entire pocket deserves far more market cap with a lot of good players around. And we are now looking at the rural facing economy. So we added more FMCG, and FMCG index has been one of the best performing ones. We are now looking at some of the agrochemical names because there will be a lot of announcements now. There are a lot of interesting developments on the technology side. Something like a nano urea. If you see, it's virtually 1/3 the cost and is used also less in terms of quantity required because it's sprayed not on underground but it's sprayed on the leaves, right? So there are a lot of stuff happening there as well. And we continue to play the manufacturing thing. And defense is where we think the prices have probably run up a little bit. So we'd like to now change our stance to neutral there.
Catch the name of the QSR stock that you like. Which is that name? And within the defense pack, any?
So we have Westlife. We have Westlife in our portfolio. The reason being that if you see in QSR, maintaining the quality is extremely important in taste, and 95% procurement for Westlife is domestic. Great ecosystem, both in terms of their chicken suppliers, their buns and other suppliers, and in terms of the balance sheet is also showing improvement, better capital allocation, very good expansion plans lined up now, and it's getting back now post COVID shock which we saw. And defense, as I said, it's this one stock which I think which is still consolidating is quasi defense plays, Solar Industries, largely because it's been a little soft as ammonium nitrate prices have been very soft. So it's into explosive, and defense order book is now shaping up very well. They're guided for a 2,000 crore plus defense order book. So we expect that to pick up, and it's a quasi play on the capex as well as manufacturing doing well. So it's one of our preferred plays in the defense space.
Gurmeet, since we're talking about expansion, how can we not talk about Interglobe Aviation after that 500 Airbus A320 family order that they've placed and a sizable capex, clearly indicating the kind of conviction that they have that, that airline traffic is going to continue to hold up and hold robust for next 5 to 10 years, perhaps.
I'll be honest, I've never made money on the aviation stock. So that's something, it's a very gruesome business. It's also called a graveyard sector. But things may be changing with just now technically two strong players, right? We had Air India ordering 470 aircrafts, now we have Indigo. So things might change. But I think I like to play that through, better place, which is travel through hotels, for example. I think look at the way Indian hotels has done well. I remember it being 2-digit in COVID, and now, see that run up. Lemon Tree is something which we like. Again, they have a 600 room coming up now in Mumbai near the airport. And the model has changed. I think now that everybody wants to have an asset-light model, more management contracts, great focus on working capital and margins. And Lemon Tree is more mid-market, so the average tariffs, etc., are also quite nice. So we like that space, and to an extent, some of this QSR, some other names, which is out of home consumption, if I were to call it, versus aviation. But as I said, it's tempting. It's just that the past experience is that we are a little afraid to take positions there.
Afraid to take positions in Indigo as it is. It's sitting at record high levels, so leaves little room as far as that buying opportunity is concerned. Gurmeet, within the pharma space, where does the preference lie? Is it the hospital names? Is it the diagnostic name? Is it the ones which have a lot of export US exposure, or is it the domestic ones?
So, you have to play the sector. It's not a homogeneous sector. So I think what happened in US generic was that everybody became very gung-ho after 2014-15, and it led to, more supply, a lot of pricing pressure. I think that seems to be now stabilizing. You've heard more exits from the US business than people entering it, right? So that's the reason the stronger will probably benefit, but that's probably more tactical, not very long term. I think the branded generics continues to do well. Look at the way Mankind Pharma has done, 99% domestic. That's more like an FMCG business. Always will command. It's like doctor prescription driven and strong brands driven, and that will always command a higher multiple. What space we like for long term is the CDMO space. I think that's one place which we call as pharma outsourcing. Valuations are very reasonable. Yes, there could be 1 or 2 quarter pain more, as the export data suggests, but that's a high margin business, and once you commercialize a molecule, it's a very lumpy business. See what's happened to Divi's and Laurus during COVID when we got the Molnupiravir thing going, right? So it's a business that you can immediately add 100 to 100 million to the top line on a quarterly basis. So you have to be in it for probably 5-10 years to play it. So that space we like for really long term. Syngene, Laurus, Divi's, good names there. And another space which we are now tracking very closely is hospitals. To us, it's more like consumer discretionary spending. As affordability picks up, as medical insurance penetration goes up. So we are tracking hospital talks. We also track some niche names there, which are into heart care, even child pediatric care.
Gurmeet, great to have you on the show as always. We'll let you go on that note.